The case for long-term investing, a lot of times nowadays I tell people that, you should invest in equities for 10 years, 15 years, etc. And then they tell me that, look, in the past everybody used to say long-term is 1 year. Then they started saying long-term is 3 years. Now your new definition of long-term is 10 years. Now, I'm not saying 10 years from perspective that every 3 years there is a market cycle. I'm not saying 1 year because after 1 year becomes long-term gain. I'm saying a reasonable period of 10 years because that's the kind of time it takes for a company to be created, for a business plan to be implemented, and for a strategic positioning to be really created. The best of companies are in business for decades and decades, and that's the time frame it takes for people to really grow. Let me give you examples. If you think Flipkart is a new company, then you need to think again. Flipkart was actually formed in 2006. So even for the new kid on the block, it's taken 8 years to get this kind of valuation that they have got. HDFC, you think, is a great company? Yes, formed in 1970. So you could have made millions and millions of rupees by investing in HDFC, but they didn't create that business overnight. They didn't create it in 1 year or 3 years. It's a company which formed in 1970. ICICI 1955, L&T 1946. So there are a plethora of such examples. TCS 1971, Infosys 1981 or maybe 1982, I'm not sure. So the best of companies are in business for decades. That's the amount of time it takes to actually create that kind of business. And what do we do here? We would like to take a call every quarter and decide on buy, sell and hold. So my net point is that when we send messages on Facebook and WhatsApp about hundreds of crores of wealth being created, it's just for us to marvel by sending it on Facebook, or is it something which we would also like to really practice? The other weird thing I've seen about investing is, a lot of times people come and ask us, because one of the best perceived banks are, something like HDFC Bank, ICICI Bank or Axis Bank. And it's a very normal thing that, investors come and ask us, okay, so I can see that there's HDFC Bank in your portfolio. So why don't you tell me which is the next HDFC Bank? Now, let me tell you something interesting. That a bank like HDFC, their earnings tend to grow at sometimes 25%, sometimes 30% year on year. The recent number has been more between 20 and 25%. Now, absolute simple logic says that if something is compounding earnings at 20% every year, then in 4 years it should double. So when people ask me that which is the next HDFC Bank, I tell them, yeah, why not HDFC Bank? In fact, I think there is more scope for that bank to double. Now, I'm not trying to give you a recommendation on a stock, but I'm just explaining some logic. So whenever somebody asks me which is the next HDFC Bank, I tend to say it's HDFC Bank. Probably they will double in a matter of 4 years because their earnings are compounding more than 20% every year. But people don't like to listen to this. They think that, okay, I don't need you to tell me HDFC Bank is a great bank. You tell me kuch tip de do yaar. You tell me something new which I don't know. So my point is that people are more likely, if I tell them that, look, there's this new bank from, say, Kolhapur, and they've hired new management, and I think they are going to build the next HDFC Bank. I think they'll make it big. So people are more likely to believe that. But there is already an HDFC Bank which was formed more than 20 years back. They have the systems, the processes, the management, the network, the team, the products, everything going for them. And I am saying that at a rate of 20% compounding, I think they will double in 4 years. So the next HDFC Bank is HDFC itself. People wouldn't believe that. But if I told them that there is some guy who's starting a new thing somewhere in the corner of the country, and I think that's the next one, people are more willing to buy that. So the whole point is that wealth is created not by looking for new ideas, not by buying and selling, not by changing recommendations every quarter. Wealth is created by identifying good quality companies and holding on to them. Because the hallmark of a good quality company is that over a period of decades, it's an expanding asset class. It tends to compound, it tends to multiply. Just to give you an example, if we are in this room today, if we, on this very table, we left, one of your fixed deposit certificates out here. We left a biscuit of gold out here or a bar of gold out here. And we left one share of, say, HDFC, ICICI or Axis Bank out here. And we walked out. And we came back after 10 years. What are you likely to find? Yes, your 100 rupee fixed deposit receipt, maybe it will compound at 8% a year. And maybe, in the next 9 years, it will double. So 100 could be 200. what happens to your bar of gold? It remains one bar of gold, hopefully if it's not stolen. And what happens to that one particular share of whatever bank that you're holding or whatever great company that you're holding? In that span of 10 years, let's say if the earning on a 1 rupee share, if the earning is 10 paisa in the first year and it grows at 20% every year, and then they issue a couple of bonuses, the whole room will be filled with shares of that particular institution and its earnings and its dividends. So what will happen is your FD receipt will remain where it is. Maybe it will double in the next 10 years or 8 years or 9 years, and your gold bar will remain what it is. But equity is what will actually fill this room. That's what is actually going to multiply, and that is why it's actually called an expanding asset class. So I think equities, good quality equities, buy them and hold them. I think that is the way to create wealth. And as you know, at Motilal Oswal, we always advertise buy right, sit tight. And recently I had this very funny experience at a conference, because the moment I said buy right, sit tight, there's one gentleman who stood up in the audience and told me, sit tight. What is so new you have said about it? We've been sitting tight for the last 7 years and we've gone nowhere. And the entire audience kind of burst into peals of laughter. And I had to rather meekly and I had to submit that, sir, the sit tight is preceded by the buy right. And you don't just generally buy anything that you like and sit tight. You sit tight provided you've bought the right stuff. Why I'm elaborating this is because more often than not, what people do is that they love to book profits, but they hate taking losses. So generally, a lot of portfolio managers, a lot of investors, a lot of people I come across, whenever they buy a good stock, when they're making money, they love to book profits. But whenever they actually make a bad investment, they hate to cut losses. And so normally what happens is when people buy right, they book profits. And whenever they buy wrong or when they make a wrong decision, they actually tend to sit tight and they become long-term investors. So yes, buy right, sit tight is the way to create wealth. But you don't implement it in halves. You buy right and you sit tight. Whereas normally what people do is they buy right and book profit, they buy wrong and they sit tight. And I don't think that is how it works. So at Motilal Oswal, we practice buy right, sit tight, but necessarily in that order. For us, buy right consists of quality, growth, longevity, and bought at a fair price. Sit tight consists of a buy and hold approach and running focused, concentrated portfolios. A lot of times people ask us that, why do you have only 12, 15 or 18 stocks in your portfolios? Why do you run these kind of concentrated portfolios? And I say that, look, portfolio investing is not about financial democracy. It's not a socialistic practice. In fact, we at our end, we really don't understand why portfolios need to have 50, 60, 70, 80 or 100 stocks. Because there is a Pareto's principle which applies always. Whether you have 50 stocks or 100 stocks, your return comes from the top 15 stocks. So normally we've seen a lot of portfolios where the top stock is 5%, the top 10 or 15 stocks constitute 30-40% of the portfolio. And then there is a long tail, the smallest stock being 0.1, 0.2, 0.5, 1 and 2. So there's this huge unproductive tail in the portfolio, which actually doesn't contribute to the investor's returns. And if one of those stocks, which is 0.2 or 0.3% of the portfolio, if one of those stocks were to actually double, anyway, it's not going to give any return to the investor. But on the other hand, if you have demonstrated conviction, if you've done a lot more homework, if you have demonstrated conviction in certain stocks and held 5 or 6 or 7% position in those good stocks, and from there it actually doubled over a period of couple of years, then the kind of return you make for your investors is completely different. So we are very clear. You implement buy right, sit tight in that order, and you run high conviction focused portfolios so that every rupee that the investor has given is in play. There's no spray and pray, hope something works kind of strategy, which works according to us. So anyway, moving on to our conversation about investing in equities. Over a period of time, what I have seen is that equities is always demonstrated as an asset class for generating higher return. People say that, okay, I need 10-12% return, so let me put X amount of money here and it will give me 3-4% more. According to me, equity is not an asset class to be put up for getting couple of percentage more. According to us, equity is an asset class which is meant for wealth creation. And wealth is created by holding good quality portfolios and riding with the entire growth. I gave you examples of HDFC. Similarly, there are examples of Nestle. There are very many examples. I would urge you to check our portfolios. There are very many stocks which we hold for last 8 years, 10 years, specifically in some of our PMS portfolios. But coming on to something different, our sense is that, a lot of people, it's not that they don't buy good stocks. A lot of people do buy good stocks, but like I said, they actually book profit and they sell. A lot of social conversations we have, and then people say, Nestle ना आपके portfolio में है, oh great company, क्या पैसा बनाया मैंने. So, but what would have happened? They would have bought at some point in time at 1200 rupees and sold it off at 1500 rupees. So, 25% is a great gain. But then they don't say that, okay, now the stock has crossed 6000 rupees. So the whole point is that, somewhere where you could have really, I hope you get the point, that somewhere where you could have really multiplied and created wealth, ridden the journey from say 500 or 1000 rupees right up to 6200 rupees, you don't do that, but the moment 1000 becomes 1200, you said you got 20% gain.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.